Good evening, and welcome to today's Market Close Report. Let's start with the numbers. The Nasdaq closed at 26,376, down 1.15%. The S&P 500 finished at 7,511, a decline of 0.57%. But the Dow Jones Industrial Average bucked the trend, rising 0.64% to close at 51,999. The VIX, our fear gauge, edged up to 16.41, still relatively low, which tells us this isn't panic selling but rather active portfolio rotation. The 10-year Treasury yield fell to 4.43%, the dollar index slipped to 99.54, and the offshore yuan held steady at 6.7561. Bitcoin was little changed at $65,780. In commodities, WTI crude oil took a major hit, plunging 5.57% to $75.89 a barrel. That drop was triggered by the International Energy Agency cutting its demand forecast and OPEC Plus announcing larger than expected production increases, stoking fears of oversupply. Gold, on the other hand, rose 0.24% to $4,353 an ounce. The big story today is structural divergence. Money is rotating out of high-valuation tech stocks and commodities like oil and flowing into traditional value sectors such as industrials and financials. Gold is also benefiting. The Dow was the strongest index today, while energy stocks and the Nasdaq were the biggest drags. This is not a fear-driven sell-off. It is a deliberate shift in risk appetite by investors. Let's walk through the global trading day. In Asia, Chinese markets were mixed. The Shanghai Composite edged down 0.11%, but the Shenzhen Component and the Chinext Board gained 0.93% and 1.72% respectively, as tech and growth stocks continued to show strength. European data was unavailable, so we cannot assess sentiment there. When U.S. markets opened, divergence was immediate. The oil crash hammered energy stocks, and money flowed out of the Nasdaq and S&P into the Dow. Nvidia fell 2.14%, dragging down the tech sector. The clear leaders today were traditional industrial and financial stocks linked to the Dow, while the laggards were energy and AI-related growth stocks. Comparing our morning call to what actually happened, we had predicted a broad risk-on rally with Chinese tech stocks moving in sync with global tech. That part was correct for the Asian session. Chinese tech did rally. But we failed to anticipate the pressure on U.S. tech stocks and the collapse in oil prices. The core mistake was relying too heavily on the previous day's strength and ignoring overnight macro shocks, specifically the IEA report and the OPEC Plus production increase. The biggest surprise was the scale of the energy sell-off. The market completely underestimated the combined impact of those two factors. Looking at capital flows, both the dollar index and the offshore yuan weakened. That tells us money is not rushing back into the dollar despite the tech sell-off in the U.S. Pressure on Chinese assets from exchange rates is limited, and the relative independence of Chinese markets is increasing. The sharp decline in the 10-year Treasury yield reflects a downgrading of growth expectations and rising bets on interest rate cuts. This aligns perfectly with the oil crash and the tech sell-off. So we have a clear resonance: the dollar falling, bond yields falling, value stocks rising, and tech stocks falling. All point in the same direction: an economic slowdown narrative and a structural shift in risk appetite. Looking ahead to tomorrow, we have several verifiable predictions. First, the Chinext Board in China may trade weak to flat as the U.S. tech sell-off weighs on sentiment, but the underlying industrial momentum remains strong. We expect a range of 4,020 to 4,100. Second, U.S. energy stocks are likely to continue underperforming, with the sector trailing the S&P 500 by 1 to 2%, as the market digests the oversupply narrative. Third, the dollar index may remain soft, trading between 99.20 and 99.80, as growth concerns and rate cut expectations encourage flows out of the dollar and into gold and emerging markets. Let me give you a clear directional conclusion. The market is in a structurally driven rotation phase, and taking a one-way long or short position carries high risk. We recommend a hedging approach. Watch closely tomorrow morning for how Chinese tech stocks hold up at the open. If the opening decline is limited, you can selectively buy tech stocks on dips while hedging against further weakness in the Nasdaq or crude oil. But if oil continues to plunge by more than 3% or the Nasdaq futures drop more than 2%, it is time to cut exposure and wait for clearer signals. Stay disciplined and stay nimble.